So we are in module 5, week 5. So let's quickly reflect on what we have done so far, because I think it's important, because obviously my goal is to build your knowledge as you go through it, piece by piece. So we learn in week 3 how to do forecast, how to do cash flow, what does it mean, learn about break even, and all that stuff that is necessary to understand how the business will look like in the future. In the module 4, we wanted to get deeper into some of the key ratios. And there are some key financial ratios like return on assets, return on equity, content that you read in chapter 2 in corporate finance book, and also learned in the MBA 633, the accounting class. So there's nothing new there. What may be new is a couple of the concepts: weighted average cost of capital, WACC, and return on invested capital, ROIC. Those are new concepts that were not covered before, so you're learning there. And again, information still is coming from, just like any ratios, coming from either income statement or balance sheet, just like some of the other ratios do. There is a bit complexity. That's the reason I provided you with the videos for how to do weighted average cost of capital. And the weighted average cost of capital basically allows us to know how much it's costing us as a company to get money from investors and from the lenders, and we kind of look at the composite of it, depending upon what percent is coming from investors, what is coming from the lenders, and then we look at it in what's called invested capital. Invested capital basically is that the money that we have invested in the business, which has allowed us to buy some assets. Assets could be machine, equipment, inventory, and those assets is what really creates our ability to generate sales and profit. We need machines, we need equipment, we need factories, we need inventory. All those are assets, right? But where did they come from? It came from either debt or equity, and so they are called invested capital. So if you want to see how much is invested capital in a company, you look at all the equity, because that's the money that has been invested in the business. And equity could be starting in equity that the investor invests, but also what the company itself is generating, which is the retained income. And that, when put back in the company, that's why it's called retained earnings, retained in the company, that becomes part of the equity. So the invested capital at any point is to look at all the equity, both initial equity and the retained earning equity, the total equity in the balance sheet, and also debt excluding non-interest bearing, because any debt that is, we are getting it through like suppliers, accounts payable. Accounts payable is the money we owe our suppliers, but we're not paying any interest on it. So it's not costing us anything. So it cannot be part of the cost of capital. So we take that out. So to look at the invested capital, all of equity, and look at the interest-bearing debt. So that becomes kind of the denominator, the invested capital. And that invested capital is used for, as you learn, to calculating the weighted average cost of capital, and also calculating return on invested capital. So now you learn two concepts, ROIC and WACC. And there is a relationship. So one of the case studies, which is more a learning case study, ROIC, that you acquired from the Harvard Business Press, talks about relationship between ROIC and WACC. Those are in some ways like a bookends, in the sense that if you are going to make an investment, you want to make sure that the return you are getting is better than the weighted average cost of capital. Why? Because that's the money return you're giving, combination, or to your investors or to your lender. So if you're going to make less money than you're giving out, obviously you're losing money. The ROIC basically is what tells us is, at this point, what return is the company generating on its invested capital. And so let's say it comes out to be, in this example, around 37%, etc. Whatever the number is, depending on the company, obviously. And so now the question is, how do we relate to the ROIC and WACC? In an ideal situation, any investment we make, we want to get a return that is equal to or higher than ROIC. because if we do, then our collectively return on investment will continue to grow. On the other hand, sometimes we will find situations, especially with a company that are high growth, that the ROIC is so high that to find projects that would be such a high ROIC may not be very plausible. So in that case, companies will, get a project that could be lower than ROIC, but definitely above the weighted average cost of capital. You don't want to go below that, because if you do, then you're basically making less money and you're giving out more money. So the takeaway was that you have two parameters, ROIC, WACC. You want to be above WACC, ideally at ROIC or higher, but in some case, if the ROIC is pretty high already in the company, because some of the projects they had initially were giving a lot of return, and now they got cash sitting, they want to make investments, and they cannot get to the ROIC. It could be okay to be slightly below ROIC, but definitely above WACC, right? So you learned all that. Now we get into week 5. What we're going to do is we said, okay, but how do we calculate this return? We want to be quote unquote higher than, hurdle rate, which is the ROIC. But how do we know that it is a better project or not? And that's where the concept of using two of the methodologies that are typically used, net present value and IRR, the internal rate of return, comes in. So in the module week 5, you're going to learn those, and then we're going to put it all together in the Jennings part E, where you're going to apply all that stuff in it. So in part module 5, again, there are discussion points. Is again 20 points this time again, because I think it is really super important. I will make you talk about WACC and discount rate and IRR and ROIC a few times, because it is that important, not just for the MBA program, but also in the real world. And so the discussion thread basically are these 6 topics, and if you start to do it, the individual assignment, one of them, is also reflecting on these exactly the same thing. So if you do it here, it's gonna make your life so much easier. When you do your individual assignment, again, you will see that the same topics in that over there in the Word document. There's also a case study that you started to look at it in the last week, called the Return on Invested Capital, ROIC, Harvard Business Press case study. There, it is a learning case study, so there is no numbers in there as much. They're mostly conceptual formulas, etc. So I will ask you, again, you can do it as a team, even though this could be done individually, and I recommend at least all of you kind of understand how to do it. There are 4 questions, and you're going to answer them. And as far as the format, you're basically answering the question. If you are going to, cite a source, then you're going to cite a source. But other than that, you can kind of keep it simple. But here are the 4 questions that you are going to answer, and that's going to start to really, really solidify your knowledge about what is WACC, what is ROIC, and more important, what are the connectivity there. I mentioned you're going to get into NPV and IRR. There is material in the book. If you feel, I think if you look at the index at the back of the book in Corporate Finance CFIN book, you can find, in the NPV and IRR. Could be in more than one places, but you can find it if you want to read it. But the videos and the material I have will at least get you quite a bit there. And if you want to read it, that's, will further enhance your learning. I provided the PowerPoints for the videos, so if you want to print it, make copies, etc. I will go over also these on our Zoom class. So, if you have any questions, we can also address it at that time. Super beneficial for your learning if you can watch the videos, before we have a class, our Zoom class. Again, I mentioned individual essay questions, same concept that you're going to be talking about it in your the discussion thread. So if you get a head start there, this is going to make your life very, very easy. Video on how to use Excel when you want to solve NPV and IRR problems. So I'm going to walk you through all that. Very helpful for you. Definitely watch it. There are nuances when it comes to NPV calculations, so worth looking at it, practicing, and so on. And from there, a quick quiz, quote unquote, basically, 10 points, an individual quiz that you're going to do to kind of test your learning, on NPV and IRR. Then we get in Jennings. Jennings case study basically will start to connect the dots for us. In here, I've given you a lot of notes. And I think it's going to help you understand it. Some of the application going on over here. So there are a whole bunch of notes I've given you. I would watch it. I mean, print it, make notes. How to do discount rate. Some of the stuff you will see is the connectivity with some of the prior Jennings cases, but also some of the videos that I've given you along the way. This is really going to help you. So the case study looks big only because I'm giving you a lot of learning notes in here that's going to help you, etc., etc. Then kind of do a practice assignment that has got answers in it. How do you do that? You're going to practice like you've done before with this stuff, with the replicate analysis, like I call it. And then you're going to go in and, basically we need the cash flow, and you're going to practice. And then you're going to go in and do it. Now, one of the things you're going to do for the assignment is basically going to replicate what we learned for the example in the case, except you are going to kind of use the 40% instead of 25% that is in the example. Again, walk it through step by step, and so it's not that complicated, but I'm giving you notes to help you. Some of you may not need it, but I think if you do need it, I think it's going to help you to do that. So in a nutshell, we are into understanding the NPV and IRR, thinking of a project, and kind of going through it. And like I said before, this class is a finance class, it's a quantitative class. I want you to understand the inputs and the outputs. So when you have a strategy, either at work or in future classes, 640, 680, or 690, you can kind of sit back and think and say, okay, what is my strategy, and how do I convert it into financial lingo? What is my sales? What is my cost, etc., etc.? What will the cash flow be? And on and on and on. So as you're going to start to see with Gen Inc. Part E, and that it's kind of building up from Gen Inc. A, B, C, and D, and E, and the next one, F, is going to even take us to a different level. So hopefully this will help you, and I look forward to seeing you in our Zoom class.